Hey cousins, happy Mindset Monday. Welcome back to the channel. It's your girl Chrissy Pips. And in today's video, we will tackle chapter 7, part 1, The Trader's Edge of our book Trading in the Zone by Mark Douglas. Now, in today's video, Mark is going to help us understand more about thinking in probability, the probabilities paradox, and trading in the moment. Now, please don't forget to hit the like button if you enjoy the content in this video. Comment below and let me know what you think. Subscribe and turn on notifications so you don't miss what's next. And share if you think others can get some value from this content. But as always, if you're here, you're interested. So let's get into it. Thinking in probability sounds a little difficult, right? Well, consistency is a function of probability. The most fundamental characteristic of the market's behavior is that each now moment or market situation or behavior pattern and each edge is always a unique occurrence with its own outcome, independent of all others. Uniqueness implies that anything can happen, either what we know, expect, or anticipate, or what we don't know. Now, a constant flow of both known and unknown variables creates an environment of probability where we don't know for certain what will happen next. This last statement may seem quite logical, even self-evident, but there's a huge problem here that is anything but logical or self-evident. Now, being aware of uncertainty and understanding the nature of probabilities does not equate with an ability to actually function efficiently from the perspective of probability. Thinking in probability can be difficult to master because our minds don't naturally process information like this. It's actually the opposite. Our minds cause us to perceive what we know and what we know as part of our past, whereas the market, every moment is new and unique. Even though there may be similarities to something that we may have seen in the past, this means that unless we train our minds to perceive the uniqueness of each moment, that uniqueness will automatically be filtered out of our perception. We will perceive only what we know, minus any information that is blocked by our fears. Everything else will remain invisible. Now, the probabilities paradox. Mark uses the casino business and how probability works in his explanation in how random outcomes can produce consistent results. Let's simplify this even more. In the market, we know that there are different patterns that can show up. We know some have a higher probability of producing certain results than others do. We know when the market is open and who the major players are. These things can seemingly show up randomly, but knowing the participants, patterns, and knowing the probability or success rate of those patterns gives us traders an edge in the market. So the thing that is seen as random can be broken down into smaller variables that we have more information on to remove some of that random feeling. Now, you can be certain that your strategy works just by knowing how effective it is when dealing with the market in different seasons, time frames, and times of day or night. Accepting the risk, using proper risk management, and knowing more helps that thing that seems so random become as consistent as you are. Having that high level overview and also having the ability to narrow down that overview is a huge help here. Now, knowing that the market will do what it wants to do and understanding how to identify patterns and trends in the market and understanding that you don't need to know everything that's going on in the market to be successful is key. Just look for your checklist, okay? Your checklist of things that you use to identify when to buy or when to sell. Now, That keeps your ego and your emotion out of the market, and you'll start to see success. The more consistent and less emotional you are, the more consistent and profitable you'll become. Now, we know that there are known and unknown variables that affect the outcome of each trade. The known variables are what we found during our market analysis, and then the market analysis finds behavior patterns in the collective actions of everyone participating in the market. We know that individuals will act the same way under similar circumstances or situations, and they'll do it over and over and over again, producing pretty likely patterns to keep surfacing in the market. Now, by the same token, groups of individuals interacting with one another day after day, week after week, also produce behavior patterns that repeat themselves. These collective behavior patterns can be discovered and subsequently identified by using analytical tools such as trend lines, moving averages, oscillators, and many thousands of other tools that are available to traders. Now, each analytical tool uses a set of criteria to define the boundaries of each behavior, each pattern, and each idea or trend. Now, the set of criteria and boundaries identified are the trader's known market variables, their edge, right? Trading also involves a number of unknown variables that act on the outcome of any particular behavior pattern and trader in the market that may be identified and used as an edge. Now, in trading, the unknown variables are all other traders who have the potential to come into the market and put on a trade or take off a trade. Each trade contributes to the market's position at any given moment, which means that each trader, their action and their behavior and their beliefs about what a high or a low is contributes to the collective behavior pattern that's being displayed at any given moment also. If there's a recognizable pattern, and if the variables used to define that pattern conform to a particular trader's definition of an edge, then we can say that the market is offering the trader an opportunity to buy low or sell high based on the trader's definition. The fact is, the outcome of every trade that anyone decides to make is affected in some way by the behavior of other traders participating in the market, making the outcome of all trades uncertain. Since all trades have an uncertain outcome, then like gambling, each trade has to be statistically independent of the next, last, or any future trade, even though the trader may use the same set of known variables to identify his edge for each trade. If the outcome of each individual trade is statistically independent of every other trade, there must also be a random distribution between wins and losses in any given string or set of trades. And that's even though the odds of success for each individual trade may be in the trader's favor. Now remember, the market does what it wants to do, and our job is to manage risk. You don't try to predict or know in advance the outcome for each individual trade. That's not necessary in order to create consistent results, okay? You don't need to do that. At the micro level, we believe that each trade or edge is unique. What we understand about the nature of trading is that at any given time, the market may look exactly the same on one chart as it did in the past. And the geometric measurements and mathematical calculations used to determine each edge can be exactly the same from one trade to the next. But the actual consistency of the market itself from one moment to the next is never the same. All the same participants who were there in the past don't necessarily have to be there right now in order for the market to look the same and make that same pattern. But because of that fact, the outcome has the opportunity to be just different altogether. The pattern looks the same, but the outcome doesn't have to be the same. Trading in the moment. Predefining the risk doesn't pose a problem for the expert trader because they don't trade from a right or wrong perspective. They've learned that trading doesn't have anything to do with being right or being wrong on like an individual trade. As a result, they don't perceive the risk of trading the same way that typical traders do. Any of the best traders, the probability thinkers, could have just as much negative energy surrounding what it means to be right or wrong as the typical trader, but as long as they legitimately define trading as a probability game, their emotional response to the outcome of any particular trade are just totally different than typical traders. Now, think about it like this. Think about how a typical trader would feel about flipping a coin, calling heads and then seeing the coin come up tails. A wrong call, but for most people, being wrong about predicting a flip of a coin would not like tap them into any point of pain, right? It's the same thing for our expert traders, our probability thinkers. They think of their trades in that same way. Just because they're wrong doesn't mean that it's going to consistently happen. They're not going to go off the deep end about it. Most people know that the outcome of a coin toss is random. Same thing with trading. The outcome is random. We just try our best to use like our tools and our analysis to kind of put more weight on one side than the other so that we know when to get in and out of the market. Now, if you believe the outcome is random, then you naturally accept a random outcome. Randomness implies, at least to some degree, of uncertainty. Now, so when we believe in a random outcome, there is an implied acceptance that we don't know what the outcome will be. When we accept in advance that we don't know how an event will turn out, that acceptance has the effect of keeping our expectations neutral and open-ended. Now we're getting down to the very core of what ails the typical trader. Now, any expectation about the market's behavior that is specific, well-defined, or rigid instead of being neutral and open-ended is unrealistic and can potentially be damaging. Mark defines an unrealistic expectation as one that does not correspond with the possibilities available from the market's perspective. From the market's perspective. The market's perspective, not your perspective. If each moment in the market is unique and anything is possible, then any expectation that does not reflect these boundaries or characteristics are unrealistic. Now, in Chapter 7, Part 2, we will cover managing expectations and eliminating the emotional risk. I'm glad I broke this chapter down into 2 parts. This chapter is filled with helpful information, but it's kind of a lot to take in all in one sitting if you do the whole thing at one time. But that's going to be it for today. Please don't forget to hit the like button if you enjoy the content in this video. Comment below and let me know what you think. Let me know what your perspective was when you went through this chapter if you've read the book. Subscribe and turn on notifications so you don't miss out on what's next, and share if you think others can get some value from my content. But as always, I hope you guys are having an awesome and productive day, and I'll see you in the next video. Bye.